Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel, where we're bringing the VRIC to you each and every week with our series of expert online panels. And today I am joined by Michael Oliver of Momentum Structural Analysis and Patrick Karim of North Star Bad Charts. This is actually a repeat of the very first panel I ever hosted on this channel, so I'm very excited to have both these gentlemen on once again. It's great to have you back on the VRIC channel.
Good to be back.
Hi, guys.
Well, I want to start with silver. Patrick, you recently posted a couple of charts on X with this caption: "This cannot be unseen. Silver's pathway to over $100." Michael, you also posted, "So now that the FOMC noise is gone, it is even more apparent that gold and silver are breaking out and about to go on a bender." So let's hone in on silver first. Break down what you're both seeing for us. And Patrick, I'll go to you first.
Man, that title sounds so clickbaity. I would never do that. Are you sure that it's me? No? Well, okay, I'll share the screen because an image, guys, like there, it's worth 1,000 words. Okay, this one here. So, okay, look, to remove noise there, like you often see that in parabolic melt-ups, like in the 1980s, the price went up super high, and then even in 2011, it ran up. But what I love to do is just go on the year. Okay, guys, this is big picture. This is yearly candles. So each one of these candles encompasses like, the whole trading year. But you see that what's more meaningful for the price action is where did it remain the longest period of time? For me, those are the levels that, okay, if we're above where like the bulk, the chunk where a lot of trade happened and where price went up, for me, that's more meaningful than the top. Because often people compare, oh, silver, it's still off. It's a 1980 high. Yeah, but goodness, it's a parabolic melt up. It didn't stay there long, guys. That thing is like, for me, it's less meaningful. It still has some meaning there on the smaller time frames. But look at that. So in 1980, we didn't have silver close above whatever. It depends if you use the futures or spot or something around $30, $31. That was the peak in the 1980s. 2011, pretty much the same area range, 30, 28, $31. And look where we are today here. I did a little zoom in here inside. And silver is testing that level, guys. Look, by the end of the year, if silver could hang on to this and even close convincingly above that 31 level, let's say close the year at 33, whatever it is there. Wow, this is a signal that we don't like. I don't want to be make this like a bigger thing than it is, but it is kind of big because that line goes back all the way like to 1980, man. And like whatever you want to call this, cup and handle, valid or not valid, guys, I don't care. This is a higher low. And now we're hitting horizontal resistance, and new uptrends are defined by higher lows and higher highs. This will be a yearly defined higher high. Guys, this is it. That's it. Yearly, it's done. And on that chart, just want to show you guys that this is for me, the biggest macro thing that silver tracks. It tracks very accurately. Well, I haven't seen a ratio chart that silver tracks more than gold adjusted for inflation. So when somebody tells me silver is, it's mispriced or it's not tracking gold, guys, this chart's telling me that silver is like a beta play. It's derivative of gold performance capacity to outperform inflation. And look at that. Look at gold. It's above. It's a 2011 high. It's above its 1980 high. Man, unless a disaster happens in the next 3 months, this is like bonkers stuff, man.
And Michael, your thoughts?
Yeah, if you put those on a log scale, were those log scale, Patrick? I'm not sure.
Yeah, those were all log. I could put it
Yeah,
back
I
there,
mean,
but
if
it's
you take the
Yeah.
swing moves in gold, that the past couple bull markets, the last 50 years, and do the same thing again, we go to $8,000 gold just to match them, in terms of log ratio scale move. Those moves lasted a decade or so. Either, ours started in late 2015. So, another year or so wouldn't shock me. We're $8,000 or even higher. There's so many events out there that are going on that are fundamental and technical that this time around it's likely to be exceptionally dramatic. And so, like you pointed out, silver, it did have two intra-month spikes up to $50 at each of those moves, but that was like, thin air last few days. So really, on an annual basis, you nailed it. I wasn't even aware of what you showed till we saw it, but we're there, and it looks like an overlay of the gold chart the way you've done it there, which is accurate. And I think silver if you do a ratio of silver to gold, go back 50 years, and let's say every year plot the highest level that silver was in relation to gold during that year on a percentage basis. What percent is silver expressed as a per ounce of gold? Right now, silver is like 1.2 something plus 1.2%. But if you go back 50 years, the number of years in that 50-year period where we've been up to 2% or 3% is almost normal. It's not like an aberration. So good grief, if gold went to even just 8,000, another replica of its prior ratio moves, and silver were to go to 2%, you do the math. Wow, okay. So silver is definitely the one that we're focused on. Fast for participation. Yeah, gold's the mama market, but silver is the dynamics are far greater on a percentage basis.
Quick break here, guys. Today's episode is brought to you by Copernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Copernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galiano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and Barrick on his board at Copernico Metals. Check out copernicometals.com. Now back to the interview.
And yet when we look to sentiment, silver is kind of in the basement when it comes, at least if I'm gauging by what I read on social media and what I see in the YouTube comment section. Trust me, there's going to be at least a few people in the comments here talking about how useless silver is. They've been stacking silver in their basement for years and it's done absolutely nothing and it was the worst trade they've ever made, et cetera, et cetera. Now that obviously speaks to the fact that people are trying to treat physical silver in their basement as some kind of investment with massive upside potential, when I think for most people, physical silver is more savings. What are both of your thoughts there on how low the sentiment is in the silver sector right now? Does that make it an even greater opportunity because so many of the market participants are kind of have disdain for silver? Patrick, I'll start with you on this one.
Yes. So sentiment, yes. The way it's weird because on Twitter, like you have daily defined sentiment, like just like charts, I have a yearly chart reduces noise. We could have spikes in sentiment on the shorter time frames, which could say we're approaching a top. But then if that sentiment is like really, there's a lot of it and it's over weeks and over months, then when it crescendos upwards, then we could have some type of more important top. But yeah, it's like nobody's talking about silver. My CNBC is not talking about silver. My aunt's not talking about silver. My father's not asking me. He's not even asking me about gold, my dad. And, he's like from Lebanon. So he knows like how to protect his assets, but he's not, it's like, it's crazy stuff. So even if gold has went up so much already, and silver is like, it's hogging this breakout line. Yeah, the sentiment, it's you need bullish sentiment to break these levels. But I think whatever we have here on the landscape of having blow off top type of euphoria, bullish sentiment, goodness, we're not even. It's like it's nothing yet. I wasn't there in the 70s. I don't know. I must have been crazy during the Hunt brothers. Like the sentiment, that must have been crazy. And today is going to be amplified, so much more. But yeah, there's no really bullish sentiment right now there. I don't feel it at all, right? It's like, yeah, I feel like, no, I don't see any, there's no like laser eyes or there's nothing like that, right? It's like, remember Silver Squeeze? Even now, Silver Squeeze, nothing's trending of the sorts, right? We're not hearing anything of the sorts. And we're at $31.
32 as we talk. 32 now as we talk.
It's at 32 now? So
yeah.
There you go. But there's no Silver Squeeze now this time. It's crazy.
I think there will be probably an event that's isolated the silver. There is one unique attribute of it above and beyond the monetary aspect, and that is its industrial use. And when you were a very young and I was a young man, silver was industrial use, was photography. That's gone. Okay. Now the solar panels. And, if you look globally, if 80-90% of the photovoltaic cells and solar panels are being produced out of China. And I've read, and I don't keep up with the fundamentals that much, but in Latin America, the Chinese have really come into that market to gobble up the silver production. And I've even read that they're paying more for raw silver ore than they're paying the pure per ounce cost of silver. And because it's an essential ingredient in a photovoltaic cell. And its cost factor doesn't apparently impact the overall price of a solar panel. So in other words, if silver goes up, it doesn't discourage people from, consuming solar panels. But they're selling this stuff in Asia and in Africa. And if you think about it for a minute, these countries are emerging, into the modern world, and they don't have what we've all got, which is, power lines under the ground from a power generator down the road, and therefore a lot of these people use cell phones and so forth, but they got no power. And so the demand for solar power, in your backyard type thing is incredible. And it's growing globally. And China, and I've read statistics on it that it's, got every year it increases sharply in terms of industrial demand. Well, we all know the supply demand of silver is fairly tight. Nobody cares, right? Okay. But if all of a sudden this story suddenly gets amplified, in some way, some manner or form, where people suddenly become aware of this unique attribute of silver, which is, been around for a while, but nobody's been paying attention to it, then you could have this squeeze effect, that's unique. That silver's got this unique thing above and beyond the fact that it's a monetary metal. And I could see silver go berserk at that point with that kind of headline, and of course all the doubters out there. And when you run a market letter or research reports, you get emails from people. And from our retail subscribers, not our institutional ones, but our retail subscribers, we quite often get, oh gosh, this silver's just behaving like heck. What do you think? What do you think? That kind of thing. And it's more negative sentiment than it's positive. And so I can feel it. And Patrick, you probably can too, that there's just, the skepticism is prevailing. It's not an enthusiasm yet.
Well, they're looking for I don't want to interrupt, but they're always looking for an exit. It's like, okay, it went up a few pips from where I bought.
Let's get out.
Patrick, is it time to exit?
Yeah.
Yeah. And I said, no, it depends on what time frame, but on the monthly, it's like the distance from moving average, something that I learned from Michael, there's room to run. It's when you're stretched away from a mean that you go, oh, okay, hold on there. We're stretched, but now when you're coiled and tight, that's where basing patterns are for. That's where people get discouraged. The bag holders I bought before, they give up. All the reasons, tax loss seasons, insert your favorite fundamental reason why you would sell. That's the basing. But when all that's complete and the moving average are coiled tight in the market, okay, I have to reprice. Like it's starting to detach from that base, and it's going to try to vacuum up to find somewhere a place where it needs to consolidate. And we're just taking off now for that recent consolidation we had.
Yeah, since May, and it's silver starting to, we plotted, like I discussed, the ratio of silver to gold price per ounce, and what's percent of silver to gold. And that is rising above 1.2 right now, which is dirt cheap, by the way, historically. I mean, to have silver that cheap, we all know that. You get above 1.3, and there's a structure when you plot the chart of the silver gold ratio. You get much above 1.3, and you break out on that spread chart, which says, I'm going to launch. And I have this suspicion that maybe by the end of the month we'll be there. And that will be a signal that coincides with silver bursting out of this recent range. The high back in May was 32 plus, okay, dropped down to 29. And back up to 32 again in, I think it was July. Sold it again there, got to 32.70, but not 33. Okay, so if you're keeping a point and figure chart, you're doing your X's up to 32, down tick to 29, back up to 32, and then they whacked it again and went down almost to 26. So down ticks that took out the prior column low. So everybody said, oh my gosh, that's a top. No, it's not. You don't go back to a double top on point and figure. You're back there now. We're sitting at a triple top on a price point and figure chart. So a guy who's a simpleton point and figure guy doesn't look at anything else. He says, my goodness, we're sitting here at a triple top. Don't use the word top. It's a triple pending triple top breakout. You touch 33. And I think that next dollar is likely to ignite more interest and a vacuum effect. Our best guess is that, I think Patrick's right. We're going to 100, 200, something like that. And probably in a year or so. But I think the first gusher could take you up into the mid 50s to 60 so fast, like I'm talking a couple of months even. It's been done before in silver. If you go back and look at the action in 2010, 11, there was a gusher. Silver like doubled in a matter of several months. And back in 1980, same story. Now, those were tops once it was through. This time, it's not going to be the case. This time, it's just a quantum leap into a new reality. And I think ultimately will drive further. But right now, just on a short-term trading basis, don't be shocked if you see silver gush up into the mid 50s to even $60 area. Boom, like that. So that's our technical assessment. And right now, the action seems to be bearing it out.
Silver will quantum leap into a new reality. You've just created the title for this YouTube video. I love it. I do want to turn to gold now. Obviously, it's been a very exciting year for gold and gold bulls. We continue to break out new all-time highs, all of that, at least in nominal terms. Rick Rules trained me. You've got to say nominal because in real terms, it's not there yet. Is this the beginning of the next leg up, or is some caution warranted here? Patrick, I'll start with you.
What did he say about gold in adjusted for inflation? It wasn't. Is that his?
It's not at all-time highs. Yeah, yeah.
Well, he has to go. Tell him to Rick, go check out my yearly chart because it is above its all-time highs, and that's more meaningful. If you want to get want to look in the future, look at the yearly chart. Remove that noise because by the time it gets to the daily or intra-day spike that it's supposed to be, man, you're going to be, you're going to be late. Like the higher the time frame, the lower the threshold because it removes the noise from the higher time frames. The lower the threshold to have a confirmed breakout. It takes more time to get that breakout because you need a year, a quarter, or whatever time frame is. But look at the yearly chart. We're how many months away? 3 months away. Am I doing math right? October, November, December. Yeah, 3 months away from that there. And gold doesn't have to close up higher than it is now. All it has to do is close where it is now, and it's a done deal. It doesn't mean breakouts they're forever, but if you want that, that's what a chart trader brings you, right? If you're above a meaningful resistance line and you break out, then that resistance becomes support. So that's when you have the odds in your favor that move is more likely to go upwards. So yeah, for me, gold, even adjusted for inflation, is looking great. Nominally, it's great. It's stretched. Like we see room that maybe before for the traders out there, like maybe a pause at 2750, 2800. You're getting stretched on the smart time frames. Expect some type of bull flag. But then some people, some of our members, they look, Patrick, after we reach this, whatever, 27, 2800, wherever it does an interim, a shorter term up, are we going to go back to 2100? And I said, goodness, I as a chart trader, I put the image. If you don't mind, I could do it real fast just to show you guys what it looks like, because a pullback to 2100 would look like. Here, I have it here. So let's say gold here starts topping whatever 2700. For somebody to expect a drop of gold to 2100, that's a nasty, like it's good, guys. Draw lines, visualize. That's going to be a huge type of move down. It's not going to happen like a rocket ship down. Gold, you're still above higher time frames, above a three-year moving average. Everything's inclining, right? Above a 1 year, above a 3 year. When you're above, you're inclining. So for somebody to look at 2100 a pullback, that's a catastrophe, and it could take time. It could take over a year if gold decides to consolidate for like another year or two, like sideways. So 2100, guys, it's for me, it's a big stretch there to go all the way back down there. So wherever we stall, wherever gold look, it's about to stall, guys. It's like, I know it could go crazy, but there's a whole bunch of measured moves that are reached, classical TA moves like up, sideways, up, pull flags. And look here at the bottom, Michael's going to recognize this. This is distance from moving average. I like using the 36-month moving average. So there's room for it to distance itself from the moving average. But once we start getting about 40% above the 3-year moving average, we could have these spikes here. Look, it doesn't mean it's the end of the road. It means you're in profit-taking zone. You could have some type of sideways move here. Sometimes here you could have was a more severe correction, that we're getting close to that, that slowdown. not quite there yet, but all we have to do is just let the chart tell you. Let it ride. And as soon as you start losing the 12-month moving average or a rising trend line, let's say, okay, I'm losing momentum. Michael's probably elaborate on that. He's going to see it in his charts when his distance from moving average, starts losing rising support lines. He's going to say, okay, well, the momentum's slowing down. Something's happening. Let's just wait until, this resolves. So that's my take on gold. It's been doing what it's supposed to do. The way Michael has probably forecast a while back, the way we've shown it, there was a high probability move to go up. And we're approaching that target where there could be a correction there coming in soon into the cards, but no reason to front run that. Just let the price chart actually start breaking down a little bit on the smaller time frames.
And for those with a longer time frame who aren't traders, it's kind of inconsequential, right?
Oh goodness, stackers don't care. Stackers on the website, they educated me. Stacker buys any day. Him, it's ounces, high, low. I'm just a little bit of my pay is going in that. That's fine. Longer term investors, look, you're above a 3-year moving average, a 9-year moving average. You're above a 1-year moving average. Like, there's no reason to sell gold. Like right now, there's absolutely for long term investors, it's in a bull market. It's in a bull market. And once it breaks out versus SPX, then you're going to be in the bull era. That's what we label bull era, like a capital rotation event. So that's going to jack it even more. So it's crazy now because now we have gold's in a bull market. It's been in a while. Silver's in a bull market. It's been there for a while. Higher lows. It's doing what it's supposed to do. But once they start outperforming SPX and the funds from the SPX start flowing to precious metals, that's when you get these crazy targets that people think we're crazy of saying back, but they're going to have a higher probability of happening there once we break out versus SPX.
And Michael, your thoughts?
Yeah, we've got a target. I mentioned a minute ago that I think silver getting through this congestion zone. It's been in since its May high, 32, now 32 again. Okay, you bust through that, and the old intra-month highs, 50. Everybody knows about them. The Bunker Hunt high and the 1980, et cetera, the 2011 high. I don't think that's going to pause or be resistance. I think you're going to blow that out. And that's when you're going to get that sentiment that says, golly gee, why wasn't I awake when this, why did I doubt it? And you get this gush of, I got to own it. It's above 50 breaking out. Well, why didn't you buy it back at, 15, 20, 30? It's at all the layers of buy signals we generated. But I think that gush is occurring. If that occurs, my bet is that the gold near-term target, not a top, just a pause, is likely to be 3,000 to 3,200. And there's some reasons for that are momentum-based. And not the round 3,000. There are some brokerage firms, I think, talking 3,000. They like to talk big. And they say, oh, in 2025, always looking way out. But I could see us get there very quickly. But on a ratio basis, if gold went to 3,000 to 3,200, only then took a pause, not a top. Okay. I think silver could easily be 55 to 60, meaning be 2% of the price of gold yet again, which is, it's a ratio that silver's had to gold so many times in the last 50 years that it's almost a norm. Okay, it's not abnormal. And then I think maybe you do get a pause, but not at some logical place where everybody says, oh, we're going to pause silver in front of 50 again. No, And I think we built the launch point to blow that stuff out, all the old $50, the Bunker Hunt highs and so forth. And I think it could occur before the end of the year, possibly even before the election. There's a lot of factors underway out there that will impact gold and silver that you've got to look at them and understand, hey, if this happens, that could help generate more power in gold and silver. Few people are talking about the dollar right now. We got bearish on the dollar after its sleepy range for the last year. Since 2023, it dropped from 115 down close to 100, and then went to sleep for a year and a half in like a 5% range, up, down, to going nowhere. It was a non-event market. Major category, foreign exchange, okay? It was a quiet one in the corner. Watch out for the quiet one. It's now just above 100. We got negative when it broke through 104.40. You drop, there's a structure on 10-year average momentum of the dollar index that says when you get into this year, you don't want to see 96 something. You'll blow the hell out of a multi-decade uptrend on momentum. You get into January, that number jumps up to about 98 point something. So literally 2% or so below where you're trading right now. If you're trading there next year, you're going to blow the bridge over the River Kwai for the dollar. Suddenly the quiet one's going to get very noisy. And there's other things going on we know too. The stock market could be a factor.
Yeah, and let's talk about that because you gave me a chart before we hit record here, and I'm going to share that right now. Talk us through what you're seeing here when it comes to the NASDAQ 100 monthly.
Well, the price at top is a price chart. Okay, it's monthly bars plotted in relation, just with the 3/4 moving average overlaid. 3/4 average is, at the end of every quarter, you average the prior 3 quarters and you come up with a new number. It's about as long in duration as a 200-day average, except 200-day changes daily. 3/4 average only clicks gears every quarter, new quarter. Next quarter, in a week, the 3/4 average is going to jump up. You see the little circle on the price chart. That's where that new average will be when you open next quarter. Be about 18,600 on the NASDAQ. Okay, NASDAQ's right, about 4 or 5% above there right now. When you run a quarterly momentum oscillator, where you plot each month's bar in its relationship to above or below where that 3/4 average is, you get a different picture than when you look at the price chart. And you'll notice that ever since turning up from that 2022 low, when we were down close to 10,000, and you turned up, the momentum broke back above the zero line. Okay, the 3/4 average, in other words. And there were 3 pullbacks. One occurred about a month or two after breaking out above the zero line. You pulled back to it and held it. Oh boy, held the average. Okay. And then you shot up. Then you came back down in late 2023 and you sat on the zero line again. Boom, shot up again. Okay. And then last month, when we were dropping from 19, 20,000 level, we said probably you're going to get a bounce at about 17,500. Why? Because that's where the silly 3/4 moving average was. And I'll be darned if you didn't go exactly to 17,500. You traded below it by about 30 points, I think. Maybe it was 100 points, but some trivial amount. And you shot up again. It's like, oh boy, I'm going to hold this line forever. No, you're not. When you build a structure and use it that many times, and it's that clear and precise, it's not subjective where you say, well, it says draw the line. Any idiot could draw that red line. I've got a momentum there. That's a structure from hell. You don't want to break. You don't even want to go back there again. Now, I'll tell you this. Before I started MSA in 1992, I was a futures broker. And I caught the crash in 87. And I caught it using the same type of oscillator here, only then I was experimenting with it. And the price chart of the S&P back then looked just like this one. Oh, it looked lovely. It just keeps going up, little pullbacks, keeps going up. It just, it's going to last forever. Okay. But when you looked at the 3/4 average, it kept for 2 years in a row, just like we've done. It came down to the zero line, zero line, zero line, and built a structure that, you don't see it on the price chart, you see it on momentum. And in the first week of October, you nipped that structure, and within 2 weeks, you crashed. When you look at the price chart, you couldn't figure out, why did this happen? Yeah. Nobody saw it coming. And after that occurred, of course, I then shifted all my technical attention to momentum analysis going forward. Price charts to me were secondary. And that right now, this is what we're looking at, is the same type of structure that says you better not sneeze. Now, people say, oh my gosh, if it goes down, gold's going to collapse too. Okay, and that's a whole different issue, but it's a falsehood. And we went in depth in the weekend report showing examples of how if you go back through the decades and circle this, that, the other, stock market collapse. The October 2008 event, which is burnt in everybody's memory, where the stock market already been in a bear market for a full year. It already collapsed in a big way, but suddenly in October 2008, a year off its high, it had a puke. It dropped like 30% in a month. And suddenly gold and silver said, oh, we're going to join you. They've been going up all that time. Stock market been going down for a year. They've been going up. So did T-bonds, by the way. And they suddenly joined in because they were technically ripe to have a correction. They needed it. And they did join in. Stock market kept going down through 2009 and took it several years to even get back to its 2007 high. And gold and silver immediately turned after that October break and took off again. But that's the one example that's burnt in everybody's memory as the truth. And when you go back in history, it is not true. And so now the question is, if the stock market does break and you get data points that follow it, which they will, that's how the data points work. They don't usually lead the market down. They occur after. The Fed's going to go apeshit. Okay, they're going to go berserk. And ECB, and they're all going to go back to doing what they always do best: destroy their money units by monetizing debt, by you name it, all the games they play. And that stock market will precipitate the onset of real to the floor policy by the Fed. And what market enjoys that the most? Okay, gold.
Yes, that's when this is for me like what we call like capital rotation event. It's once the market realizes that, let's say the Nasdaq starts going down 5%, whatever, 10% starts going down. It's fair. Like let's say it's a correction, but once the market, the aggregate of market participants start realizing, oh boy, okay, this is not stopping at 5%. It's not stopping at 10. It's not stopping at 15. Once there's that point of recognition, and they realize we're going in for 30, 45, that's it. Because all bull eras again for precious metals, not just gold going up nominally in price, for gold outperform SPX, the instigator, it's a 30-40% drop in the stock market. In the 60s, late 60s, they did a couple of those. In the 2000, it was that 40-50% drop. It loves that. It needs that, because for me, that's the true flip-on switch, where afterburners, where the true money, instead of flowing into the SPX and those 401k plans, just all that money slushing in there, the fund managers, okay, hold on, maybe I should slow down the pedal and start allocating elsewhere. And then that huge institutional money comes in once their numbers, their performance. Look, I have time to show you a chart on this there
Yeah, of course.
to reinforce the point that Michael started with the Nasdaq. I'll just share you this one. This is the Dow Jones, because it's the weakest of the main indices, but I'll show you maybe SPX priced in gold, guys. And look at this bottom. I have distance from the 36-month moving average, and goodness, look at that. For me to get bullish Dow Jones in real terms, it would have to get back above this line, and it's just falling apart there. I don't know, maybe there's a longer trend line. It's falling apart. Even the price on the monthly chart, the Dow Jones has broken down. Goodness, you could even say it broke down here, retest. It's happening. The Dow Jones is breaking down priced in gold. And then I'll do the Nasdaq, the almighty Nasdaq, but we know what we're talking about here. We're talking about the Magnificent Seven, right? Because if equal weighted, look at the distance from moving average. It's falling. It's not doing new highs, right? And as soon as it breaks below that zero line here, we're going to start doing new low lows, lower highs, lower lows. It's the beginning of a downtrend, right? And then after that, we're going to start breaking down longer term stuff. Look, we're not doing new highs there. This is priced in gold, the Nasdaq. Maybe I could. It's like it's getting close there. It's getting close to falling apart there. And even that line here, support, resistance, support. So that ratio, like of 7-to-1 for NASDAQ, when gold's worth 7-to-1, it could be a top. Look, it's not this in hindsight, we'll know this was a top. We still need the evidence that could still be a continuation pattern, but the setup is, and the momentum here is not this is not giving me hope that this will resolve upwards, right? There's no evidence right now that wants to resolve upwards. We need for the price to distance itself from the moving average. Start running away from it to think that is a continuation pattern, right? So in real terms, right now, the NASDAQ has a setup to falter. The setup's like there. And I showed you the Dow Jones already falling apart. The Russell, forget it. Russell's already down. It's broken versus gold, price in gold. The Dow Jones, and historically over 100 years, the SPX has always followed Dow Jones. They're highly, highly correlated. So where the Dow Jones goes versus gold, you could historically, SPX always went the same way. So, and the Nasdaq is going to do the same thing. So we're seeing in the future now, we're seeing the building blocks of this capital rotation event where I'm just waiting for the market to realize that when the next correction starts, that once they realize that's the one that's going to lead to 30-40% drop, that's the floodgates, man. People start panicking, and so we're still ahead of the curve, guys. It's crazy. Even at gold at 2,600 and silver at 32, we're still ahead of the curve. It's crazy.
Let's talk about uranium for a moment here. Or sorry, Michael, you had another comment to add?
Oh, no, I was just going to say that Patrick's notion of the shift in asset manager preference, it's already underway. Not with grand headlines, but back in February, Druckenmiller bumped a bunch of big name techs and bought Newmont, biggest gold mine in the world. Okay. And if you go back and look in mid-February when that announcement came out and circle where Newmont was, it was like $32. It's trading 55 right now, thereabouts. Okay. So he's done pretty well. Okay. He foresaw he is not alone. There's plenty of them out there who have this itch that, I need to start moving some assets out of this higher risk, less reward arena, the stock market, because they have their doubts, whatever their doubts are based on, macro fundamentals or technicals. They have their doubts, and therefore they're moving money, maybe 3-4% here, 5% there, not overwhelming, but still it's underway. And that's why you see Newmont go from, nobody's pounding the table. Newmont went from the low 30s to the mid 50s since February. Okay. And that's not a headline. Okay, fine. Great. Super. I like it. But when that happens, when more and more of them start pushing that button, and it's a matter of, hey, am I hurting or feeling good? Ooh, I may not like gold fundamentally, but it feels good. My buddies, they bought gold and they're doing well. Their performance is beating the public, their competitors. I need to buy some gold or gold related. And that's already underway. And there's a point at which even the asset managers are like the public. There's a huge swing, an emotional swing. And I think it's underway. And I think it'll increase, especially if you kick in the shins of that NASDAQ or the S&P. And cause them to all of a sudden there's 5 or 10% they didn't expect, or 20 or 30. The flow could be massive, especially into the gold miners, which is a trivial little sector. I mean, it'd be like wet bar of soap being grabbed. Enjoy.
Well, let's talk about uranium here for a moment. Okay. It looks like the equities have started to come back from a drawdown. The sector is so unbelievably volatile. The swings in prices day to day are very tough to stomach for the social media crowd. We were talking about silver and silver sentiment earlier. I don't know if it's silver investors or uranium investors who take the prize for the biggest whiners out there. But I'm wondering what your thoughts are on where the uranium and the equities are currently positioned. Once again, uranium has made quite a big move since 2020. Is this a time where you would be trimming profits if you got in early, or is this kind of a longer term bull trend that you're both seeing? And Patrick, I'll go to you on this one.
All right. Well, of course, I'm going to pop up a chart because that is the truth, right? The objective truth. I'll put Cameco because for me, Cameco is the it has more data. It goes back to 2000s. It's the oldest uranium miner I could find, and it's always been outperforming. Most of the time, it's been outperforming URA. So if Cameco can't do it, yes. So Cameco lost a rising trend line a few months back. It was stretched from the moving average back in. Here was the peak. Here's the best it could do. See, again, it lost a rising
Good
momentum.
Good chart.
Mm-hmm. Yeah. Well, Michael, man, I gotta give you a lot of credit because you're the one who instigated. There's a couple of people who I saw use distance for moving average, but the way you do it, it really crystallized in my head. Okay, this is it's slowing momentum, right? You're going on the highway. Yeah. You have to accelerate, right? And but before you go rewind, you have to slow down, before you could put it in reverse, unless everything blows up. So it's the low risk entries, guys. They're always when the momentum is coiled and tight and breaking out. It's expanding away from the moving average. That means the money's coming in so fast that you're able to expand away. But as soon as you can expand away and the momentum starts crashing, the price, I don't want to say it crashes all the time, but you're 100% in a correction. And look at that.
Mm-hmm.
Look where it signaled the top there. Here,
Mm-hmm.
look at that
Mm-hmm.
before. So right now, uranium, what's good for uranium is it tracks gold, it tracks silver. So most of the time in the bull run here in the 2000s, uranium is one of the first one out of the gate. So uranium did well early, but it kind of peaks like in 2007 it peaked, right? And then in 2011 it barely went even if gold kept going up. So gold and silver for me are like the big daddies that will close up the commodity bull era show. So uranium, it's nice what's happening now. I'm gonna get interested once like some type of breakout will happen in the momentum, or like something's still gonna happen here. Will it rocket to the moon now? I would love to see some type of a more meaningful type of flag, to create even a low risk entry point. But right now,
Mm-hmm.
uh, it looks like just a bounce on the 3-year moving average. But look, on the long term, it's still an uptrend, right? It's like, are you a trader? What are you doing here? Are you a scalper, day trader, a position trader, investor? People got to establish that way before they enter a trade. Don't, because you're going to get baffled because
Yeah.
or else, let's say you go in as a trader and then the momentum breaks down and the price breaks down, and then, oh, I'm not a trader anymore, I'm an investor. For me, that's a total fail, because now you've trained your premise, your trading framework. You should shoot yourself. That's the error. The error is not that the price went down. The error is you didn't respect your original framework. So before you go in, decide what you want to do with this. Are you investor above an inclining 3-year moving average? That's it. You're still above inclining 3-year moving average,
Mm-hmm. Mm-hmm.
So shorter term, uranium had a lot of damage. Now it's bouncing. It's trying to create some type of bull flag consolidation pattern, but the low risk entry is not quite there yet. Yes, in hindsight, somebody say, "Oh, Patrick, you didn't buy the bottom, the bounce." Well, I don't care giving up that percentage bottom there. I want a more proper, lower risk, higher probability setup. We're not quite there in uranium, Jesse. Sorry,
Yeah.
uranium bulls, get mad at me. I know you know who you are. But guys, it's getting close. I'm going to get super bullish uranium, like that line I showed you, and our members know, like, I have no issue jumping back on board there. It just needs a little bit more for me before trading that thing again.
And Michael, how do you currently view the setup for uranium?
Well, Patrick and I did not share notes before this. Okay. I agree with him totally. Dead on. Okay. The chart he had of Kamiko, we did the same with uranium futures, which are highly illiquid. They're nominal at best, but you can still plot them. And back in 2018, coming up from underneath 20, about 22, we turned major bullish in August 2018, based on the similar chart that Patrick just showed you using on Kamiko. And it was a massive 3-point downtrend line on annual momentum. It broke out. It didn't explode right away. It did start to advance, and ultimately we quintupled. Okay, beat the heck out of the commodity sector. Quintuple. Okay, but the problem was, as he shows, the recent drop broke something, and it broke a steep annual momentum uptrend. Now, if that annual momentum uptrend down near the zero line, down near where the 3-year averages, that'd be different. Then it'd be more potent. But it did enough damage to where I would say, hey, if you're just getting long uranium now, you're late. We said get long at $22. You could have gotten long at 30, 40, 50. You don't get long at 100, or, et cetera, et cetera. It's too late. That doesn't mean what it looks like to us, though, is just what Patrick summarized. It looks like a congestion zone likely outcome, not a major decline. This is not a top. This is a pause, and it may last for a couple quarters. And I agree. I don't think you've seen the low yet on for instance, I ran URA before it came on here. That's the uranium companies, which Kamiko is at the top weighted. And it looks like you've broken enough stuff to where it's going to take a while to heal, and you're going to get ups and downs. Right now, I think URA is up to like 28 or so, and it looked to me like you might see 29 or 30 in this rally, but don't look for any more than that. It looks like it needs to base and pay some dues, inject some pain in the arms of those people who came in late, They should have come in early, not late. And ultimately, yes, going higher, but no, not right now. It's a sideline commodity. It definitely led, commodities exploded in late 2020. We put out a buy signal called a commodity explosion. Bloomberg was 70, then it went to 140 by the time that war started over there, and then peaked. And during that time, it doubled, but uranium quintupled. Okay, so it led. Well, right now, uranium's not a leader. Okay, it's still part of the pack, but it's not a leader.
Michael, I see the sadness in Jesse's eyes.
Has he got a
Hey,
position?
I am uranium is about 40% of my portfolio, but I did get in at 2020, 2021, so I'm up at least 50,
Well, super. You're in
60% on
good
most of
shape.
my positions. Yeah. And I also tend to not speculate on junior cos and stuff like that. You see a lot of the people with broken sentiment on Twitter piled into these explorers without discoveries, or these types
Yeah.
of companies. So I think company selection matters. Yeah.
Well, that's the guys. Look, Cameco is the flagship. URA. If you're not performing URA or Cameco, why are you? Don't go into that clickbait. Oh, it's a 10x. I know some mining companies never took off in that whole run. How heartbreaking is that? You see, Cameco, it's a big cap company that gets even bigger, and people want to buy it because a big cap company can't do a 5-bagger. They don't buy it. They want the 10-bagger, but then some of their 10-baggers are just crappy companies that never take off. So
Yeah.
and you miss a whole bull run because you got greedy. It's like, go for the chart there. If that chart's giving you a 5-bagger or whatever it is, a low risk entry point, go for that, guys.
Yeah. And position sizing, if you got a little extra change on the sidelines that you want to toss into some, hole in the ground that could 100x, then great, use gambling money for that, right? Don't use real capital. WTI crude, we saw it back over $70. Where is it right now? I'm just want to check in here. We're at 71.32 as of this second. A lot of the equities still look undervalued to me. I don't look at charts very often, except for just looking at the whole history of a company. I don't have a lot of technical analysis skills, so I could be mistaken there. It looks like a lot of the companies are pricing in that hydrocarbons are going to be phased out of the energy mix. We've seen a lot, and again, this is on the fundamental side. We've seen a lot of funds divest themselves, get away from hydrocarbons because of ESG concerns. We've seen the political elite pushing the fact that oil's going away. I'm wondering what both of your thoughts are on the oil and the natural gas sector. It's interesting because I had Lee Gehring and Adam Rosenzweig on the show a couple weeks ago, and they think the setup for natural gas is unlike any other commodity at the moment, which is interesting because a lot of people are bearish on that particular commodity. So I'm wondering what both of your thoughts are on both oil and natural gas. Patrick, we'll go to you first.
You're always letting me first, man. What's up with that?
Well, you bring up the charts and then
All
we'll
right.
comment on
Okay.
them.
Well, for me, oil. I'll show you oil, guys, and
Yeah.
my thoughts on that natural gas there. Oil is in survival mode. So I haven't. I'll put on the, let's say, quarterly chart, reset chart view, and that spike is a killer for chart traders, guys. That spike it did there, it forces me to always have to scroll and see like. So this is the oil chart. There's the peak in 2008. And I'm just going to put a horizontal line right here. Look at that thing. Goodness gracious. It's on. I'm going to remove the Ichimoku cloud. It's the buyers are coming in by the end of the quarter, man. They're trying to keep this. There's like a zone here. Oil is it's in trouble, but it's in a bullish looking trouble. Here is, Michael probably saw that already. So rising uptrend, momentum broke down. So right now, it's a beautiful pull flag pattern morphing into existence. But before you get bullish, you want to explode away from that 3-year moving average, that 36-month moving average. You get bullish right there, or like maybe eventually somebody could get more aggressive. But until you get back above this zone here, oil, it's like it's going sideways now. But what does that mean when you're sideways? You're at risk of going down. Why put yourself through that while you could buy something like, let's say, silver that is going up, that is breaking out? It's just like oil's done its move. Now we just have to wait for that thing to resolve. There will be a great opportunity, but you have to wait until it resolves. And it's not because of oil. It's like an inflation indicator. It traps all that inflation, but accumulates it. So it's a mix of purchasing power destruction and inflation. So I don't care about this ESG, blah, blah, blah. You insert, I don't want to dismiss. I know I get in trouble sometimes on Twitter because I get in arguments. I fight off the fundamental guys. But guys, if you're going to look at one fundamental, you got to accept that there's a fundamental that you don't know. Right? It's the unseen consequence. It's the basics of economics, right? It's the window that breaks. Oh, good. We're generating some economic growth there. The window broke. Yeah, but that money could have went into something else, right? More productive. It's the unseen consequence people have a really hard time on like grasping. So for me, that's the oil chart. It's bullish. Look at the long term, like the 200-year chart. I know it's super long term, but look at this thing there. Reset chart view. Like, oil, it's up, sideways, up. Bullish. Yeah, I have mentioned this. Remove indicators. Sideways, and that next one could be another big leg up, guys. So this sideways, and this is a cumulative effect of we could have something really, really big. That's like oil price since 1861, guys, like super far away, right? But we could have. It's just a sideways move we've been creating since the 2008 top. So that's a huge pattern, a bullish expanding wedge, maybe for third. So once that resolves, opportunity of a lifetime. Like once that resolves, it's a huge crazy move at 2000s, or even maybe I think sometimes I've been looking at charts. I think we're going to do something more like the 70s, maybe bigger. Sometimes it's like a combo of the 2000s and the 70s. It's like something much bigger is morphing into existence. And natural gas is just, it's the widowmaker, guys. Guys, it's the widow. It's like every time I look at that chart, people love trying to catch bottoms on this thing, but as a chart trader, for me, it's almost unplayable, that thing. It's like there's no clear patterns. It just shoots up violently. Yeah. So natural gas for me, it's like, yeah, there's not much for me to do there. It's not a very nice trending instrument. By any means. Maybe somebody could zoom in on the weekly, get some more precision there. But there's I stay away from maybe you see there's something maybe nicer here happening. Yeah, maybe a little slight momentum breakout here. Maybe something can happen. But maybe for a trader, have fun with natural gas. It spikes, all that. But for me, I'd rather the monthly chart, ride these powerful, longer, higher probably trends. And yeah, natural gas, man. I don't want to be a victim of that widowmaker there. That's nasty.
And Michael, oil and gas, how are you currently looking at that sector?
Well, they move with the Bloomberg. Okay. They don't move with gold, although I think now the Bloomberg is set to follow gold up. Okay. If you go back and look at what happened to the Bloomberg Commodity Index between when gold made its low in 2015, December, through 2020, it doubled. From late 2015 through summer of 2020, Bloomberg went down the whole time. It was in October 2020, coming up through 70, we got bullish, went to 140. Well, oil and natural gas were leaders in that move on a percentage basis. Natural gas went to $10. We did catch that move. The pullback is much deeper than we thought it would be. However, when we run our quarterly momentum, you remember that S&P chart we were looking at, quarterly momentum. We run the same thing on natural gas and oil. We see a pending breakout ahead. In the case of natural gas, it's already trading at a level that if it closes a month next quarter at the level it's at now, will break out. Meaning that pullback down into the $2 area is a base. And in fact, it's spent enough time paying its dues down there. It's going to turn up again. Well, crude oil has a similar structure, handful of dollars above where it's trading right now. But if you look at Bloomberg too, for some reassurance that it's not just the energy, Bloomberg, after the war Ukraine started, collapsed from early 2022 to late 2022, early 2023, and made a low, bounced, made a second low, bounced, made a third low. All the lows were about a couple points apart. So really, even though it made a new low 3 different times, they were like marginal. 3 times all you get, guys. Okay. We were trading with a 93 handle, I think last month or this month. We're now at 100 on Bloomberg. Nobody's noticing that. It's got a quarterly momentum breakout structure pending, just like natural gas, just like crude has one pending, and the grains also have similar structures. So I think natural gas and crude, yeah, they got their own fundamentals, but they're moving with the pack. And you can look at the Bloomberg and see the similarity. Sometimes they outpace it, sometimes they underpace it, but in general, they move together. And I think the whole board, the whole Bloomberg Commodity Index is about to turn up. And that's just what the Fed wants, right? Okay. They want to print the money to save the stock market. Fine. Asset managers are going to put it in somewhere that's cheap and low risk. Where's that? Commodities or commodity related stocks. So, yeah, I see the energy sector ripe for an upturn here.
Well, excellent comments from both of you. This has been a fantastic conversation. Michael, tell us about momentum structural analysis, what it is you do there, where people can find it.
We've done it for 32 years now, 1992. Okay. Mainly institutional clients, but then in 2015, we opened up to retail subscribers. We look at all four major asset categories in our all asset reports. That's the bond markets, the debt markets, the stock markets, commodities, and foreign exchange. Because they're all impacting each other. So you really don't want to just have blinders on and look just at gold or look at the S&P. You need to be seeing what these other guys are doing because they impact each other. And I think we're not to promote what we do, but I think right now we're at one of the ripest points in market history for dynamics, not just in gold and silver, but in a lot of markets, different directions. Real dynamics, the kind that you lose teeth over, okay? And they make headlines. And I think it's about to start like right away.
Well, I'll put a link in the description to Momentum Structural Analysis for people who want to check it out. Patrick, tell us about NorthStarBadCharts.com.
That's right. Well, yeah, North Star Bad Charts. I started that with Kevin Wadsworth. Some of you might know him as a North Star Charts on Twitter back 3 years ago. But yeah, essentially, it's we like to call it chart-defined macroeconomics because instead of us having a thesis and pushing it, it's look what are the charts telling me, and we do a lot of inter-market analysis, the ratio charts, what is outperforming what, and after that, choosing the best instruments within those fields. And once you know that you're able to look at all the plethora of asset classes, then you're always on the right side, right? You're not stuck, like Michael said, in a bubble. Because let's say the bear market happens in uranium or in gold, what, you're just going to wait 15 years? You could be a stacker, but if you want some to write some nice trends there. And yeah, indeed, there's these big patterns now that are morphing into existence that are starting to break out. Like I showed you that yearly chart for gold, just for inflation, that silver chart. Those patterns, man, they're going to generate some huge violent moves up. It's energy in or energy in a base. That same angle of energy going down is often replicated on the way out, and that is violent, right? And that's where you make the greatest gains in the shortest amount of time, and that's all we could wish for.
Well, I will put a link in the description below as well to NorthStarBadCharts.com. Gentlemen, it's been a fantastic conversation. Thank you both for coming back on the show.
Thanks, Jesse.
Thanks, Jesse.
Michael.